Hello, everyone, and welcome to the month of August, which brings us to a new compliance corner. So with the compliance corners, as we've done in the past, we're going to bring you some hot topics that we've encountered throughout the month. And with the previous slides, there will also be a link to additional information. So when you see an asterisk by an item, make sure to check the description in the video below, which will have a link so you can have some further reading if there's a particular topic that you want to dig more into. But with that, let's start with a quick summary of what we will be looking at and covering for the month of August. So we're going to start with a few different cryptocurrency related items. First, we have some DFI guidance on fraud prevention measures for Bitcoin ATM operators. Then we have an interagency statement on crypto asset safekeeping by banks. And then we have an item from FinCEN, which is a notice. This is specific to convertible virtual currency kiosks. So CVC kiosks related to some scams and other schemes that are going on with these that you're going to want to be aware of. After that, we have a trigger lead bill to become law, which is some good news that we'll talk about. Some additional CIP-related agency releases that have been rolling out, a discussion on VantageScore 4.0 and what that means for credits reviews. And then lastly, we have a change to the Comptrollers Handbook, but a significant one here, with OCC's removal of references to disparate-impact liability from that booklet. So with that summary in mind, I will hand it off to Heather to start our discussion.
Thank you, Scott. Thank you very much. So as Scott mentioned, when you see an asterisk in our materials, that means that there is an accompanying link where you can pull the actual item for further review. And we have included for you the actual guidance that has been recently issued by DFI. It's interesting that the guidance references Bitcoin, but when you actually read the guidance, it is talking about a broader, that being the virtual currencies. And you'll see Scott pick up on the same vein on the federal side. But as many of us know, being in the industry that we are in, there are ATMs that allow for consumers to use those ATMs to purchase or otherwise transact with virtual currency. And we have seen in recent times, more recently than that, but there unfortunately have been some scams that are occurring in these types of operations. And so DFI, who happens to be the regulator for the area of law that is the money transmission law, which is Chapter 217 of our state statute, they recently issued guidance as a way to try to help prevent fraud that they've identified as occurring through these virtual currency ATMs. And so we have for you on the slide a little nutshell of what those restrictions or what those preventative items are. One is to limit the amount of dollars that a transaction could occur per day for a customer, and this is set by DFI at $2,000. And then also a requirement to have on the machine as well as separate text within initial screens on the ATM machine, prompting the customer of a caution about possible fraud. There's a prescribed notice that needs to be provided. It has to be certain language, has to be certain font size, and it has to be in certain locations as the guidance further outlines very briefly within that information piece. So we share this with you from two different perspectives, one being an awareness, because many of us who are on front lines that are responding to questions of customers' inquiries or concerns, or on call centers, again, fielding customers' concerns. We want to make sure that you're aware of this guidance because perhaps the bank has virtual currency ATM operators, and this is something that they need to be aware of. But then just the overall awareness of some fraud prevention tactics that are being put in place at the state level. And then as mentioned, Scott will cover the federal level, which is similar in nature. You'll find that this is a united front through many of the state and federal agencies really trying to help prevent the fraud that unfortunately is occurring on some of our customers. So FYI on that one. So a little bit more positive note, on the next slide, we wanted to share with you that the federal banking agencies have issued interagency guidance. And this particular guidance is on crypto asset safekeeping that are services that banks may be able to perform. So this is something that is not new. Banks have been able to perform safekeeping services previously. However, as you've seen us talk about, and perhaps you've separately read yourself, there's been a little bit of a shift about the willingness or the open-mindedness of crypto assets, so put it that way. And so the agencies have this newer guidance, basically reminding the banks that this is possible, but there are some considerations that you should take under advisement if you are going to be going down this path of providing safekeeping services at the bank. And for purposes of this guidance, safekeeping means the service of holding an asset on a customer's behalf. This could be a service that the bank is doing perhaps through their trust services in the role of a fiduciary, that you have a trust officer who is acting as a trustee for a trust customer, or perhaps acting as personal representative or other types of fiduciary roles that it plays through a wealth management or trust services. Or it also could be services that the bank is doing in a non-fiduciary standpoint, where the bank has actually entered into a contract with its customer to provide this service. In either case, the guidance sets forth some expectations that when you read through the guidance, I do believe, Scott and I believe, that your examining team is going to come in looking to make sure that you have thought about the risk considerations that are within this guidance. And you should be prepared to explain to the examiner the steps that have been taken by the bank to mitigate those risks, to recognize those risks, and to incorporate procedures and operations to try to protect the bank against the most severe of those risks. So we have here for you the bullet points of the different categories of risk that are addressed within this guidance, that being risk management considerations, the actual management of the key themselves, right? As you understand, some of these crypto assets, the key is an important component. If you're loosey-goosey, for lack of a better term, with a crypto asset key, it could involve unauthorized transfer or otherwise loss of an asset that the bank is trying to safekeep for its customer. So key management considerations are certainly an important component here if offering safekeeping services. Also, take a look at your legal and compliance risk. Certainly, Scott and I, specializing in this particular area of law, recognize that there are certain types of technologies in this crypto asset area that just by the mere function of the digital ledger, that transactions can occur that don't have the information that we need from a BSA standpoint to make sure that we're complying with our O-factor and other types of anti-money laundering or other just know your customer types of information. So be careful about the legal compliance risks. Just know what you need to identify as those risks. And then certainly third-party vendor rules come into play here, that if you are using a third party to help with this particular service, make sure that you keep them under close watch, because you will be responsible for the actions or the inactions of that third party that they're performing on behalf of the bank. Certainly some unique systems need to be put in place. You want to make sure that your IT area is aware of how those unique systems work for just the functionality of providing that safekeeping and tracking of the uniqueness that is crypto assets. And then finally, audit. We always need to make sure that we have a component that is offering the checks and balances, that what procedures and programs have been put in place by management, that in fact has been carried through, and that there have been tests to make sure that there isn't a gap in what has been identified as a process, and again, mitigating those risks. So very helpful guidance. It isn't new, but I do think a lot of common sense to work through if in fact you're going down the path of offering safekeeping of crypto assets as a service for your bank customers. So Scott, I know you've got another topic that's very similar in nature with this unique virtual currency area.
That we do. So we course, have all sorts of information on cryptocurrencies here for you. And the last one for today, as Heather had been saying, is on the federal side. Basically, FinCEN is saying, hey, we've spotted some issues with these CVC kiosks as well, right? So in that conversation, FinCEN put out a notice, and we just have to be aware of these new criminal trends in this area, right? And this is specific to misuse of convertible virtual currency kiosks, as FinCEN calls them, or CVC kiosks. So similarly, right, they're more commonly known as crypto ATMs, Bitcoin ATMs, however you want to call them. They're within that sphere. But we'll refer to them as FinCEN does for sake of this item as CVC kiosks. And as Heather mentioned in the DFI alerts, we know that some of these are around Wisconsin as well, right? DFI is aware of them. Some of you have maybe even seen them within your community. And if you are, they're popping up. Just make sure to be aware of them and the potential risks that they pose. And for sake of this FinCEN notice, kind of what FinCEN's expectations are. So specifically, FinCEN put this out early in August, warning that these kiosks are just being used more and more by scammers, transnational criminal organizations, drug trafficking. And this is part of an effort to start raising awareness about this. Make sure that financial institutions are able to take proactive steps in identifying when these transactions are occurring, when there might be suspicious activity related to your customer, how they're using them, pulling out cash to potentially be coached to use them in these transactions, and of course, reporting them as a suspicious activity. So from a broader perspective, actually, thought it was interesting to pull out some data that FinCEN had in here. FBI's complaint center received nearly 11,000 complaints on CVC kiosks, losses exceeding 246 million. Now, whenever we talk fraud, we're aware of the big numbers, right? To put this in perspective, just for sake of understanding the trends, that's a 99% increase in complaints from the previous year, right? So a jump in years of where we're seeing these. So it's very much a new thing as we come here into 2025, still being new, right? Now, the way the scams work is they often involve typical schemes that you're all familiar with, right? Tech support fraud, bank impersonation, romance scams, fake investment schemes, right? Things that we've seen before, but the method is different. So victims are directed to then bring the cash to these kiosks, sending the funds to the criminals, where then, of course, it's gone. It's also popular with drug trafficking to launder money. They've become very popular because of the fact that the speed of it, right? The speed, anonymity, geographic flexibility, and moving illicit funds instantaneously anywhere. Another important point of the notice is that FinCEN, of course, acknowledges that many CVC kiosk operators aren't complying with their BSA obligations. And that includes failure to register, maintain appropriate records, or file SARs. So this is from the operators, right? And while banks don't typically operate the kiosks themselves, FinCEN is pointing this out to urge financial institutions to help by identifying and report the suspicious related activity, right? So when you're filing a SAR, if it's related to a CVC kiosk, so that they can identify it and law enforcement will know that that's involved. So some things that you can do are red flags. So again, take a look at the notice to see them. But as an example, customers taking out high dollar transactions, right? And maybe talking about a kiosk, or you know that they're bringing it to a kiosk, or they have QR codes that are being provided by unknown individuals that are being used to identify where it's going to be sent. Make sure, as always, frontline staff and customers know how the scam works, know the risks associated with these machines, especially since, again, they're just going to be directed to bring money and deposit them there. Then when you are identifying that and reporting a SAR, there are key terms. FinCEN identifies it, so make sure you're using that so law enforcement can then track and investigate appropriately. As Heather had mentioned, DFI is aware of this. We've seen other states, this in other states as well, potentially even lawmaking in other states. While Wisconsin hasn't enacted similar laws, that DFI notice is still relevant. This notice is still relevant, right? The call to action is still here. So make sure to stay vigilant, stay proactive, and be aware of unusual withdrawal patterns, helping a confused customer, and again, filing those SARs so that they can be effective. So with that, we'll wrap up our cryptocurrency items, I'll hand it back off to Heather for our next slide.
Thank you, Scott. Another item that is important here in Wisconsin and on the federal level is something that Scott and I have been working on for the last 2 sessions. We field calls from our members on a very routine basis of frustrated bankers who have had customers receive inquiries from others within the industry because of a mortgage application, and they're frustrated because they've been just peppered with phone calls offering credit products and other loan products, and the banker is frustrated, the customer is frustrated, and so we've been trying to have a change of federal law to limit those types of calls. And so here we have some good news to share. We have the passage of the Homeowners Privacy Protection Act, otherwise known as the Trigger Lead Bill that we've often referred to this in the past. And what this does is this will amend the Fair Credit Reporting Act. Now, this has passed both houses of Congress, and we're awaiting time of this video for it to be signed into law, but it will be coming down the pike here very soon. And once it is actually signed into law, there's a 180-day time period for it to become effective. So we have some implementation periods here. But in short, what it does is it changes the Fair Credit Reporting Act in a way that credit reporting agency will no longer be able to share consumer information, consumer reports like they have previously done when we're dealing with a residential mortgage transaction. So what the law will now become is that a credit reporting agency will be prohibited from providing a consumer credit report to a third party asking for it in connection, again, with the residential mortgage transaction, unless some conditions are met. And the first of those conditions being unless that third party actually has a firm offer of a credit product or an insurance product that they plan to make to the consumer. And more importantly now, the third party needs to either provide documentation certifying that the consumer has given that third party consent to receive that credit report in connection with that residential mortgage application transaction, or that third party has either originated a mortgage loan on behalf of the consumer that's related to the consumer report. That third party is the current mortgage servicer of the consumer connected to that consumer report, or that the bank holds a current account for that particular consumer. So when those conditions are met, then the consumer reporting agency can provide that consumer's credit report to that third party. And if not, then they're in violation of the Fair Credit Reporting Act. So we're very, very hopeful and expect that all of those phone calls and text messages that your customers had previously been receiving without this change of law, that's going to be narrowed down to much fewer instances. Now, I will say that in Wisconsin law, we do have some provisions that protect our banks that third party is not able to use a bank name or an image in a way that's deceptive or allows for a third party to think that the information is being made on behalf of the bank. That is still within Wisconsin law, and that's broader than just something that's in connection with the residential mortgage transaction. So we want you to know about this trigger lead law change. However, from the broader context, if you ever see solicitation that is misusing the bank's name in a way that's deceptive to the consumer, please reach out to Scott and myself, because we have a procedure whereby we can reach out to DFI and make them aware of that particular action and ask for them to issue a cease and desist where we can. So it's a little bit beyond the scope of this particular law change, but because it wraps together sometimes these activities that we see by third parties, we wanted to remind the membership of that particular option underneath of our services that we offer to the members. So with that, I'll turn it back to Scott for a few other items to cover yet in this video.
Thanks, Heather. Yeah, just a few more things to wrap up on these next couple slides here. We'll take them at a high level, but they are important to be aware of. So first one, FRB has joined the other agencies in issuing a CIP exemption for banks to choose to collect the customer's tax ID number from a third-party source, meaning you can get it from that third party rather than directly from the customer before opening an account. It's important to say this is optional, so it doesn't change the other CIP requirements. It's just intended to accommodate digital account opening in a more flexible way to kind of reflect how identification verification tools are evolving, and that way to kind of fit it into your CIP policies. We've seen the other regulators have issued similar exemptions. So at this point, most banks will likely have access to this, depending on their primary regulator. Next, on the same slide, we have a quick update from FDIC on the topic of digital account opening as well. So in this new guidance, FDIC has clarified that banks can use pre-populated customer information. So data from an existing account relationship or maybe something from a third-party source, depending on your system, when you're opening new accounts. That said, there are two key conditions to be aware of. One, customers need to be given a chance to review, correct, and confirm that information. And be aware that the bank still needs to meet its CIP requirements, right? So again, still needs to be able to form a reasonable belief about the customer's identity. So still, helpful clarification there, but it's really just that clarification for banks looking to streamline onboarding and still be able to meet your CIP requirements. Key takeaway being that these pre-filing is permitted use through these third parties. If you're deploying that or you have it available or considering it is permitted, but just make sure that you're able to adhere to your CIP policy and still be able to incorporate those components which have not changed. On our next slide here, just a couple more things to discuss. First, we have a few quick updates on VantageScore 4.0. So this is a credit score model that's been becoming more popular. It's developed by Equifax, Experian, and TransUnion. Here, the point being that Fannie and Freddie will accept this score for all mortgages that are sold to them. And this is effective immediately. So we got a link to that, so you can pull that up to see that announcement. But it essentially marks a significant shift from the previous reliance on the classic FICO models. And so this should, in theory, expand access to mortgage credit. So FHLB Chicago also allows member institutions to pledge mortgage collateral using VantageScore 4.0. The idea here being that for banks, for you, can take advantage of this to lend more to diverse and creditworthy borrowers where previously it might have been more difficult to review them on the classic scores. According to FHFA, lenders can then choose between the classic FICO and the Vantage scores when you're going to be looking to deliver those loans to GSEs. So the choice of this, the point is to have a model where there can be a modernization of credit scoring, promote competition, of course, but also choose which most appropriate. In theory, giving a broader view of a consumer's credit history, right? Which can then help with those who might have limited or even no credit history to give them better opportunities for home ownership, to reach those underserved borrowers and reflect the growing acceptance that we're now seeing of this in alternative data models. So for example, the scores that rely more and look more on rent or utility payments to conduct credit scoring. Lastly, just really quick here, we have an update from OCC. So this relates to disparate impact, right? So this is actually very significant for fair lending. Now, disparate impact is an aspect of fair lending that's created when you maybe have a neutral policy or practice. So fair lending, of course, if there's overt discrimination, which anyone familiar with fair lending is, of course, familiar with that, is a violation. But you might have something that's not necessarily an overt violation, but there's a result, right? And so there is a discriminatory result where a bank wasn't purposely discriminating, right? Wasn't necessarily redlining, right? Drawing red lines on a map, but there was a practice that resulted in a disproportionate result where you are excluding a protected class, or there's a harm resulting to a protected class as a result of action. What OCC has done is that it will no longer examine banks for disparate impact liability under fair lending laws. And this is a result of an executive order which had directed the federal agencies to eliminate it, eliminate the analysis in all contexts. So the result being that OCC examiners won't assess or follow up on disparate impact risk or internal processes. So It's important, though, to keep in mind that OCC is still going to examine for fair lending, right? OCC is still going to look at fair lending. OCC is still going to look at risk assessments, still going to analyze data, and it's still going to take action where there is evidence of violations. So while disparate impact is no longer a part of OCC supervisory focus, make sure you are still aware of fair lending, aware of the implications, aware of how policies and procedures impact your customers, and just overall the takeaway of treating customers fairly, right? So not only complying with those overt requirements, with the explicit requirements of fair lending, but fair treatment of customers across the board, complying with all applicable fair lending laws as a whole. So that's all we have. I will hand it back to Heather to wrap us up.
Super. Thank you, Scott. And as we always like to do, we like to remind our members of the various resources that we have for WBA. So don't sign off yet. Keep in mind that we do a lot of work on behalf of the membership, creating compliance tools and putting together publications, putting together FAQs and various guides on a number of different topics, both on the federal and on the state side. So be sure to check out the WBA Best Practices Library. Also in the library, we have information from our various committees. There are brand new items related to trust and the importance of having and using a corporate trustee. Scott put together a fantastic new guide about the trusted advisor or authorized list resource within the Best Practices Library. So a lot of things in there. I'm even twisting the names around inadvertently. But there is certainly a lot of information within the resources, both on the trust side and on the non-trust side, when you're looking at Wisconsin law and state law. Also, we want to make sure that you take the opportunity to be involved with WBA and broaden your engagement. And that can include being an advocacy officer for your financial institution, helping with providing input on regulatory items, and on state-related items. Become part of a committee, whether it be the retail committee or HR committee, mortgage lending committee. Just are short examples of those different opportunities where you can network with each other, provide some insight and some information back to your industry and become involved in that way, as well as Scott and I are able to help out with your other compliance needs, whether it be answering a call through the hotline or doing in-house compliance training with you, where we provide the background legalese and you then can provide your bank-specific operational asks of your staff. So a lot of collaboration going on between us and members that we're very happy to customize for your needs. So please check out all those different resources. Give us a shout. We're always happy to help you through what your question might be. So until next time, we hope that you enjoy the rest of your summer, and we look forward to meeting you again here in September with some new information by the state and federal agencies. Till then, take care.
We'll see you then.